To our market update for today, the 27th of March 2022. Gosh, she flies by, doesn't she? Another year getting well into her. And another really exciting night for you guys that lined up as you start and look for the market for the week ahead. We're going to open up today with Ash on the FTSE. I had a mammoth few months of in that particular product. We're going to then listen to Geoff on technical analysis, and then George is going to give us some price action. We're going to be here for about 20-25 minutes, and you guys are in for one heck of a treat. As I said, sometimes we have Ash come in and do data. He talks about COT. Brilliant, Alexis. We'll add you on. We'll have Alexis in as well doing some fundamentals for us. We'll put it between Geoff and George. Ash is one of those guys. Sometimes he comes in and he talks COT, seasonals, fundamentals for us, but today he's talking FTSE, his pet product, the one where he's had an amazing run. Ash, what do you see in the week ahead?
I see some downside, actually. I'm going to show you my screen, and we're going to look through just some of the evidence which would suggest that to me. Now, I've been looking at FTSE actually going short for a little while now, as it goes, and I've been expressing that sort of through my trading. I've been taking some shorts on the market, but the market has continued to push higher. So you've got to be kind of careful with how you trade this particular run that we're having. Look at the seasonal data. Now, the seasonal data suggests just a little dip. Now, this is March into April, and the seasonal data suggests that a relatively flat few weeks, but just a small dip into April. So the final week of March into April, which is this week. And then if we look at the weighted average, then that's very, very bearish, and then it tends to bottom out around about April when the market tends to go higher. Now, the budget statement, the spring statement, is one of the reasons that the FTSE would tend to push a little bit higher during this period. But the statement was incredibly underwhelming this time round, so that may well affect the FTSE. On top of that, you've got Russian firms being effectively ejected from the FTSE. Evras, Polymetal, Raven Properties. Now, particularly Evras and Polymetal, these are big companies that are getting kicked off the FTSE 100. So that could be an aspect, and that's happening again this week. So that could be an aspect which could see the FTSE start to dip lower. If you look at the broader picture, the S&P, the Dow, and the Nasdaq, the American markets will affect what happens in the UK. So if we see an equity sell-off in general, then that will affect the FTSE 100, even though the American market is probably still more overvalued than the European stock market. All of them will probably be affected negatively. And you can see that, when we look at the Dow, similar thing. It starts to dip down at the last week of March, just a little bit of downside in the last week of March before we tend to see a rally through April. Same with the Nasdaq, same with the Nikkei, and just here with the Nikkei, and same with the S&P. So equities tend to do quite poorly. Well, not poorly is the wrong word, because you can see that the move down isn't that significant, but they don't tend to rally in the same way during the last week of March. Now, we don't have COT data for FTSE, so we would have to look at what the equities would suggest in the United States to give us just a little bit of a hint what could be happening. Oh God, I can't show you that now. Why does that kick me out? I don't know. Let me just see if I can do it on this one. No, I can't do it. It's just kicked me out the website, and the passwords and the logins are a little bit convoluted. But if you were to look at the COT data, if you guys have got the subscription here, if you look at the COT data for the S&P, starting to look quite negative, particularly on the speculator side. The speculators are starting to come out of the longs and increase their short offerings. So that would be the sort of some of the background detail on the FTSE 100. Now, if we just quickly look at the chart on the FTSE, here's the FTSE 100 on the monthly, looking very, very positive, an incredible bar in many respects. The fact that we dipped down so low at the start of the month, and now we're back to where we are. That's near a looks like 10 to 15% gain. So a 10 to 15% swing, sorry, almost a 20 to 30% swing on the FTSE 100 this month. This would suggest that we are at resistance, this point here. And if you look down at the dailies, then we do start to see a potential emergence of a diamond pattern, which would be relatively negative. Things are still kind of bubbling over in Ukraine. I think that we've got too much uncertainty to suggest that we can just go and buy this stock market without any kind of volatility and any downdraft in between. So for me, this week, mate, we are looking at shorts in the FTSE. Whether they will follow through, obviously a big question. But I think a bit of profit taking in this particular area would suggest that from what we've seen with the data, that suggests that could be the case. A big move down would see us here, all the way down there to retest this area. A gentle move down would see us around about the monthly pivot, which is currently around about 2%, a 2% drop down in the FTSE.
Yeah, it's certainly a weird looking chart at first look, isn't it, Ash? We get this big correlation between Aussie yen and the stock markets, which is a very similar chart. But you look at this and you just go, what's driving that up? Price of oil is troubling and going to cause cost of supply to go up to everything. Inflation is going to be supply side driven and looks to be here for a little while. War in Europe and, NATO talking about, digging in for the long term here. They don't seem to think this is going away. It doesn't seem an environment to be massively speculating on UK stocks, does it? No,
you're absolutely right, mate. And I think it's quite significant, the ones that are being taken off the FTSE. As you rightly point out, we look at the Aussie as a bit of a barometer for global health of growth. But that's a commodity-based currency. So in some respects, it should be doing quite well, in this particular environment. Everas, that's a commodity-based stock, and that's going to get kicked off the FTSE 100. That should have some kind of sway on the actual price. The FTSE does have commodity-based companies that are at the top end of the market cap, which is why we do see this kind of bubble, if you like. Banking stocks, commodity stocks, and oil stocks do drive the FTSE higher. But we've seen in the last few weeks what happens when people start taking profit on oil. It drops significantly. So it only takes something small, I think, when you start to walk on the edge of a cliff, for somebody just to poke you in the ribs and you may well fall. So that's what I'm suggesting may well happen. I'm uncomfortable trading long given the uncertainty. So I think some downside is likely.
Mate, do you think for the average retail trader new to the market, learning it, they need just to wait for a little bit of confirmation?
Undoubtedly, because the thing with global equities is that that there's that common phrase: markets can stay irrelevant or irrational longer than you can stay solvent. And in some respects, we've got maybe a bit of a case of an irrational market. We've got Fed hiking rates. That's going to have an effect on growth. We've actually got growth numbers. You see from the UK, consumer confidence the other day was absolutely atrocious, and these are forward playing numbers. These are things that we know are coming. We know that there has got a high probability of a recession, but the stock market will ignore that while they believe they can squeeze as much out of it, and there's always that question of whether the institutes are drawing people into the market just so they can actually clear out their positions. And not that I would want to try and trade off that, but there's always that at the back of the mind, and you've got to keep that in mind when the stock market goes higher and higher and it starts to look toppy. Don't get overconfident that this thing is just going to keep going. But yes, waiting for the correct signals is integral because of the irrationality of the market.
Yeah, really surprising for me that 3 days ago we had a really nice selling day, and I'm really surprised we didn't see some follow through from it. It just looks like perfect level, rejection of it, great place to go short, and you might have expected a bit of follow through. That's my only sort of concern looking at the chart. Mate, thanks as always for your input, and we will keep an eye out for an opportunity to get short on the FTSE. It's certainly a fascinating chart, Ash. One thing I really like, I like it when markets are interesting. There's times as a trader where markets just aren't interesting, and trading, it doesn't offer you much of mental stimulation in some ways. But these markets are fascinating right now. We have some opportunities around, and we need to make sure we make the most of them. Thank you very much for your analysis as always. Look, I'm going to go. Thank you. I'm going to go next to George, and I'm going to have my play George's recording. And after my play George's recording, we're going to come back and we're going to hear from Alexis on fundamentals. George, we're talking price action. We're having some issues with Geoff's recording. So we do need to get to George if you can, Mike. You okay to play George's recording, Mike?
Hey, trading buddies, I trust you all well. Ash, I don't know, I can't remember how far you live off the coast, man. So please excuse me if you're right next to it. But Geoff, this probably won't mean much to you. But we took a few days out of busy Johannesburg just to come out to the ocean. And these are just the views. Today is pretty cloud covered, but it's our last day. We've had a beautiful 4 days. So that's where I'm doing my recording from. But I'm gonna switch off the video just after sharing the screen so that we don't distract the guys. And let's have a look at just a couple of things that I wanna discuss very quickly. So here's a few things that I look at. And typically, you know, I don't talk much about these things because it just happens at the back of my mind. But I was just thinking about what to share today, and I think it's very important. I talk a lot about looking at the low of yesterday, the high of yesterday, looking at, you know, you got to set these key levels in if you're trading intraday, like I do. Open of the day, or open of the day must always be in there. But there's something else which is always at the back of my mind before I start the trading day. And I'm always looking at where price action is on the daily in relation to the 10 EMA, that's an indicator of breakout strength for me, and also the 20 EMA, pretty key level of support or resistance. But specific for today, I want to just suggest to you guys that you really learn or force yourself to look at the 3 days before yesterday. So before the previous day, the 3 days before, it just focuses you on the market and looking at what's actually been taking place in the market. So here are the 3 days before yesterday, that inside candle, bull candle, bull candle. Now, clearly you can see the market was in a pullback. We got within those last 3 days to the 10 EMA, failed to close above, got an inside candle, good for the bears, but the bears failed to put a low to close on or near the low, which is an indicator of strength. Inside candle would have been a good breakout candle, breakout pattern for the bears. But then the day after, despite the weakness shown by the bears, that's yesterday, we then had a trading range. So coming in today with that 3 days prior to the previous day, having a look at it, you're gonna be expecting that this trading range is pretty strong. So any breakout above it, you can look for a failed breakout above it and pull back into the trading range, which you can trade back in the trading range. The bears reassert themselves because we are this low and that they failed to close beneath, give us a low close on this day. We'll also look for a failed breakout and a pullback in the trading range. However, if the bulls are strong, you're going to think of measured moves, right? Measured move above the trading range, which comes to test this level here, which is high of 2021. That's an area to look for shorts. Or if the bears are strong and they now give us a close to a measured move, then we can start to say, hang on a second, possible double bottom. Let's see if we can come back up, or if the bears are strong, acceleration down. So that's on the UK 100. Another interesting one to look at for the session today. Again, same kind of thinking that I'm trying to emphasize. There is previous day, yesterday, low of the day, but also we are in the zone of the high of 2021. So pretty strong level of support. We also have the high of yesterday, but let's look at the 3 days before yesterday. 2-bar reversal took place, so indicates pretty strong level of resistance here. Bears had a chance at that time to come and at the test of the close, test of the 10 EMA, give us a close somewhere beneath there. And if they were strong beneath this level of support, which was high of 2021. But they failed to do that. And if you look at the price action above the 10 EMA, so all the selling we're talking of has turned out to be bears taking profit, because the bears are failing to put a close beneath the 10 EMA. So if you look at these last 3 candles, it suggests for us that the market might just bounce off here. It might give us a double bottom, an attempt to break beneath this today. but there is still opportunity for the bulls to break above here, but they're only going far as a level of resistance. But if you're trading intraday, if you get that breakout, good enough profit opportunities for you. Last one, very quickly, same kind of thinking, very interesting on the euro. So this is yesterday, good bounce off the 10 EMA, good for the bears. But let's look at the 3 candles, 3 days before we got to yesterday. So the market pulled back. Yes, it did. Got to the 10 EMA, had a close above the 10 EMA. So this is the indicator of strength. So bulls had the opportunity to close strongly to give us a follow through above that and get to the 10 EMA. They did give us that, but they bounced off the 10 EMA, which indicates that the bears are still strong in the market, and that reversal very good for the bears, follow through good for the bears. So today, if you're in the market on euro, you gotta be looking 60% chance. I'm 100% right 60% of the time. 60% chance that the bears will break beneath this low. And if they do, what are they looking for? They're looking to close beneath this previous low, which was when the market turned and pulled back and was profit taking. But also, if you look at this Fibonacci expansion, leg 1, pull back to the top of the pullback. So it could be a little bit more precise. If you wanted, just plonk it there. First leg, pull back, perfect low 1, first pullback after this breakout, absolutely perfect for you to look at. And of course, we got triggered in, but they're looking for low 1, leg 1, pull back, leg 2. So there is the goal for the bears, an extension of that first leg, equidistant extension. But they also would like to close beneath the measured move of February's trading range breakout. So if you go to the month of February trading range, okay, so the bears are strong. Yes, they break beneath that, but they have to close beneath the measured move of the trading range to give us indication of continued strength going forward. So guys, I think that kind of thinking yesterday, of course, but then 3 candles before will give you opportunities and where your certainty should lie. So hope you enjoyed that. We will catch up with you on Wednesday, live trading profits, which is 11:30 GMT on Wednesdays. But also, if you have subscribed to my Wednesdays at the market, free one, second Wednesdays,
now if you want to mind.
Thursday and fourth.
Cheers. Look, everyone, we've had a couple of issues today with videos. We know it's very rare for us to have these issues, but both Geoff and George's original videos, both George and Geoff's original videos haven't come through well. George asked us to play that one instead, which we've done. Geoff is out this evening. I sent a video earlier, and we got it. It just won't play. It won't play on my system. Won't play on my system. It's been unusual, so I do apologise for that. But given what's going on in the world, we've got Alexis who's offered to come in and do an extra session on fundamentals. And look, we're in a fundamental market right now. There are big things happening in the world, and it's affecting the price of everything that goes on in trading. So Alexis was kind enough to offer to come in and do an extra session on fundamentals. So we'll wrap up today with Alexis and the fundamentals. I'll be back after her. Alexis, over to you.
All right, thanks, Paul. And yeah, it's really interesting what's been happening in the market. And I'm just going to give you guys some a couple of tools to take a look at and a bit of background on why we are looking a bit at fundamentals. So I'm just going to give a simple analogy, right? So what is fundamentals? Fundamentals is like the health of an economy, right? And if you think about economies as humans, if humans can get sick, economies can get sick as well, right? But if your immunity is strong, if you are healthier, you kind of recover from the illness faster. So it's very similar to what we are looking for in economic statistics with actual countries, right? The healthier a country is in terms of GDP, interest rates, so the GDP is like the heart, right? It gets the economy pumping. Then you have the interest rate, the inflation, imagine all these like cholesterol levels, etc. So what we're looking at the overall health of the economy. And even though there's an economic downturn or there's a general fear in the market or whatever, right? What is important is the healthiest economies will bounce back faster. The healthiest economies will recover faster. And this is why when we're looking at statistics, we're not just trying to see who is performing better or worse. We're trying to see overall which economy is healthier, so that when things start changing, right, or when monetary policies or fiscal policies like interest rates, inflation, etc., when the doctors start prescribing the medicine, we want to see who responds faster, who gets up on his feet faster, and who bounces back faster, because this will give us the indication, and we are trying to find also the weakest versus the strongest economies. So Trading Economics is a website that I use pretty often. It's a free website, so you guys can go take a stroll through it. There's a lot of data in there. But what I've compiled is I've just pulled out the couple of commonly traded economies that we are looking at. All right, so these are what I am focusing on. I'm focusing on GDP, QOQ, which is a quarterly figure, and of course interest rates, inflation, and jobless rate. All right, so I've categorized them a little bit over here, and just going to quickly run through on what I am looking for the next coming week. So if we look at GDP figures, all right, GDP figures, I put on these three in a more slightly positive area, these 3 or 4, because their GDP is currently it is currently on the high side. Okay, I think the pound goes to the neutral side. My apologies. All right, so actually no, I cancel that. I know why I put the pound there. Okay, so I would say these have a positive GDP. You can see their Kiwi, Aussie, and dollar. The dollar has like a 7% GDP. The Kiwi and Aussie has 3.4%. So they are what considered pretty strong, pretty healthy GDP. And then if you look on the other end of the spectrum, we have the medium range. The GDP is performing only at 1%, or 0.3, 1.6, and of course the lower end would be the 0.3s. All right. Interest rates, right? The highest interest rates currently is held by the New Zealand economy, 1% interest rates, followed by 0.75 the pound, and then of course dollar and the CAD 0.5. And I put the Aussie in blue because the Aussie, strangely enough, seeing the rest of its counterparts increase its interest rates, doesn't have plans to do any immediate increase. What they have instead come out and say that they're keeping an eye on the economy. And if we look at the flip side, look at inflation. Somehow Australia has, I would say, controlled inflation. It has a decent amount of inflation, higher than their normal, but it's not too high comparatively to the rest of the economy. Look at the USD 7.9%, and the 3 great ones, the inflation rate average among the rest of the bigger economies now is about 5.9, 5.1, 5.0, 5.9. And of course, most importantly, these are the unemployment figures. Now, the euro, understandably, is having its highest unemployment figures. It's about 6.8 at the moment. But if you look at the unemployment figures, you will see that the Kiwi, the Aussie, the US, and the pound, they seem to have balanced it out, meaning that it's not too high, it's not too low. Yeah, it's controlled. All right, so I wouldn't say it's good or bad. I would say it's controlled. So if we look across the board, what I am trying to find is I'm trying to pick up what is the healthiest economy. All right, and currently my top 3 picks will be the Kiwi, the Aussie, and the dollar. I'm a bit more leaning towards Kiwi and the Aussie because they do have a decent amount of GDP. All right, based on their previous quarter, and their interest rate, is pretty nice. And Australia's unique because it doesn't really need to increase interest rate at the moment because its inflation is controlled. All right, so the figures might not be as easy as comparing more or less. And remember, fundamentals is never about one statistic. It's usually a bigger picture, right? It's a big picture. It's a big chessboard. You have to kind of look at the overview and balance all these factors out. So if you look at the factors, we're looking at 2 countries which have healthy GDP, all right, a healthy heart over there. They are controlling their interest rates. Inflation is a bit high on the Kiwi side, but they are attempting to bring it under control. But most importantly, unemployment is controlled as well. So I'm looking at continued strength in the Kiwi dollar, Kiwi and the Aussie. And I am going to be looking for weakness in the euro and maybe the Canadian dollar. All right. Now, Canadian, I put under the neutral because CAD is a commodity-based currency, meaning that it is very responsive to oil. All right, so this will be a bit more. You have to be a bit careful if you're trading the CAD. Just taking it based on the statistics itself, because again, the bigger picture, there is a lot more factors that go into commodity-related currencies, and this is part of the reason why Australian dollar is doing pretty well as well. All right, so what I'm looking for next week, I'm just going to jump to quick charts. I'm going to look at Euro Aussie, Euro Kiwi. And actually, that's basically all we really need to do, just weakest versus strongest. I don't want to look at too many as well. So if I look at the Euro Kiwi chart over here, all right, you can see the Euro Kiwi, just based on statistics, just based on the current, conflict climate around the area, it has broken and made new, testing new bottom support levels. Will it go lower? Let's go on a weekly time frame. I would say that there is room. Okay, there is room for more downside. We can possibly hit a 2017 low if the conflict doesn't resolve. All right, so we have a little bit more of distance to go. So just because it's overextended over here doesn't mean it's going to reverse. So I know reversal traders going to be finding it very tempting to try to go long here, but let's look at the bigger picture. The bigger picture is the conflict doesn't seem to be going to resolve so soon. It is still a protracted situation. Euro's economic health is not the best. And, there is room, right? We are not at the extreme support levels. There is room for more downside, so I would be definitely more comfortable looking for short opportunities at the relevant retracements over there. Similarly for Euro Aussie as well, this is a weekly time frame. And if we look at the weekly time frame, it has made kind of new lows as well. All right. And it has broken through some of the technical levels over here, or is reaching the technical levels over here. But again, it's not at its absolute lowest. 2017 is the previous historical low that we're looking at. So I would see a little bit more downside, but again, be prepared for reversal traders coming in and trying to push the market back up. But in the bigger picture sense of things, I think the probability of that happening is really hard given Euro's weaker economic statistics. All right. So for the Euro to recover, it's going to take a big announcement by the government, by Lagarde. Something big has to happen if it is to strengthen again. All right. So this is the overall medium term, I would say, while the conflict is happening. And what I will be continuing looking at is weakness in the Euro and taking advantage of that, pitting it against the strengths in the Aussie and the Kiwi. That's all for me, Paul.
Hi, Alexis. Thanks for that, and thanks very much for coming in and doing this for us today. Great to have your input as always, and we're interested to see how some of these fundamental things play out, Aussie, Kiwi, and Euro in particular. To the team, thanks for being here today and sharing as always. Hopefully we've got your trading week off to a good start, and we'll be back next week. I think next week's Ainslie Gordon, Ainslie on oil, gold, and Gordon on stocks. I will check that, but I'm pretty sure it is. We'll be back next Sunday. We'll see you guys same time. Thanks for joining us today, and we'll take care and we'll see you guys then. Thanks, everyone. Cheers.